Silver is sitting at $79 right now, and at first glance, nothing about that number looks extreme. It looks stable. It looks controlled. But that stability is exactly what makes this moment dangerous, because underneath that price, there's a growing mismatch between what the market is showing and what the physical reality is becoming. And that gap is about to be tested by a very specific event that is already scheduled and already confirmed. In less than 3 weeks, a policy decision made by China is set to hit a critical point in the global mining supply chain. And almost no mainstream coverage has connected that decision to silver. Not because the information is hidden, but because the connection requires understanding how silver is actually produced at scale and where it really comes from. Because the truth is, most silver does not come from silver mines. Roughly 70% of global silver supply is produced as a byproduct of copper mining. That means the availability of silver is directly tied to the operational capacity of copper extraction. If copper slows down, silver slows down. And copper mining at industrial scale depends on one specific input that cannot be easily replaced in the short term. That input is sulfuric acid. This is where the situation shifts from interesting to critical. China is the largest exporter of sulfuric acid in the world. And beginning on May 1st, 2026, that export flow is being halted. Not reduced, not limited, but stopped. That is a documented policy action with a defined start date. And that start date is not random because it lands at the exact moment when another part of the system begins to experience pressure. May 1st is also the beginning of a major silver futures delivery cycle. That is when contracts move from being financial instruments into potential physical obligations. Most of the time, this process happens quietly because participants roll their contracts forward instead of demanding delivery. But when the physical market is tight, that behavior changes. More participants choose to stand for delivery. And when that happens, the system has to provide real metal, not just paper promises. So now you have two forces arriving at the same time. Upstream supply faces disruption because a critical chemical input is being restricted. And downstream demand begins to test the availability of physical silver through the delivery process. Those two forces do not normally collide on the same timeline. But this time, they do. And this is happening in a system that is already under stress. Silver has been in a structural deficit for multiple consecutive years. And that means more silver is being consumed than produced, not occasionally, but consistently. Industrial demand continues to expand, driven by sectors that are not slowing down. Solar energy infrastructure, electronics, medical applications, and defense systems all rely on silver as a core material. These are not optional uses, and they are not easily substituted. At the same time, new mine supply is not keeping pace. Developing new mining capacity takes years, not months. Even under stable conditions, supply response is slow. But these are not stable conditions. When a key input like sulfuric acid becomes restricted, the system loses flexibility. Production cannot simply adjust upward to meet demand because the process itself is constrained. This is where the physical market begins to send signals that the price alone does not show. One of those signals is the structure of the futures curve. In a normal market, future prices trade at a premium to spot prices because of storage and financing costs. But when immediate supply becomes tight, the opposite condition can appear. That is when the spot price begins to command a premium because buyers want metal now, not later. That condition is starting to emerge, and it is one of the clearest indicators that the physical side of the market is becoming strained. It does not generate headlines because it requires interpretation, but it is visible in the data. And it is consistent with what would be expected in a tightening supply environment. So the situation becomes very specific. You have a market that is already running a supply deficit. You have industrial demand that continues to grow. You have physical signals indicating tightness. And now you introduce a new variable, which is a disruption to a major upstream input that affects the majority of global silver production. And yet, the price remains at $79. That is the disconnect. That is the tension inside the system. Because the price is not a direct reflection of physical availability in the short term. It is a reflection of the paper market where contracts trade in volumes far exceeding the actual metal that exists for delivery. That structure allows price to remain stable even as physical conditions tighten beneath it. But that stability is not permanent. It depends on the ability of the system to manage delivery expectations and maintain confidence in future supply. When those assumptions begin to break, the adjustment does not happen slowly. It happens in stages. And those stages are often triggered by moments when the physical market demands more than the system can easily provide. That is why the timing of May 1st matters. Because it is not just a date, it is a convergence point. It is when a supply constraint becomes active, at the same time a delivery mechanism begins to test the availability of metal. And when those two dynamics meet, the system is forced to reconcile paper pricing with physical reality. Silver does not break all at once. It tightens first, quietly, gradually, in ways that most people never notice because the price itself does not immediately react. And that is exactly where this market is right now. Not in a state of collapse, not in a state of panic, but in a state of compression where multiple pressures are building at the same time beneath a price that still appears stable on the surface. To understand what happens next, you have to stop looking at price as the leading signal and start looking at structure. Because structure moves first. Structure reveals stress before price is forced to acknowledge it. And right now, the structure of the silver market is sending a very clear message that something is tightening in a way that cannot continue indefinitely. Start with inventory. The available pool of physical silver that can actually be delivered into the market has not been expanding. It has been trending lower over time, not in a dramatic collapse that creates headlines, but in a consistent pattern of withdrawals that reduces the buffer inside the system. And that buffer is what allows the market to function smoothly during periods of high demand. When the buffer shrinks, the system becomes more sensitive to any increase in stress. Think of it like pressure inside a closed system. When capacity is high, fluctuations are absorbed without issue. But as capacity declines, the same level of demand begins to create instability. The system does not fail immediately, but it becomes less tolerant to shocks. And that is the phase silver is entering. Now layer in behavior inside the futures market, because this is where the difference between paper and physical becomes critical. Most silver trading does not involve physical metal. It involves contracts that represent future delivery. And under normal conditions, those contracts are rolled forward rather than settled in metal. That is how the system maintains stability, even when the volume of contracts exceeds the available supply. But that behavior depends on confidence. It depends on participants believing that metal will be available when needed, or that rolling forward is the safer choice. When that confidence starts to weaken, behavior changes, and that change does not need to be large to create impact. Even a small increase in participants choosing to take delivery instead of rolling forward begins to stress the system, because the system is not designed for a large percentage of participants to demand physical at the same time. It is designed for most to stay in paper. That is the foundation of the structure. And when that foundation is tested, the system has to respond in ways that increase cost and complexity. Now consider what happens when that shift in behavior meets a constraint in supply. Not a theoretical constraint, but a real operational constraint introduced by the restriction of a critical input. Sulfuric acid is not just another commodity, it is a required component of large-scale copper extraction, which is where most silver supply originates. When that input becomes restricted, the ability to maintain or increase production becomes limited. This does not mean mines shut down overnight. It means flexibility is reduced. It means output becomes less responsive. It means that the flow of new silver entering the market becomes more constrained at the exact moment when demand may begin to rise due to delivery pressure. And that combination is what creates instability. So now the system is dealing with three simultaneous pressures: a declining inventory buffer, a potential shift in futures market behavior toward physical delivery, and a restriction in upstream supply that limits the ability to respond. Each one of these on its own would be manageable. Together, they create a situation where the margin for error becomes very small. This is where price behavior starts to change, but not in the way most people expect. It does not immediately spike. It tests. It moves toward resistance levels that have held in the past, and then it encounters opposition. Selling pressure appears. The price pulls back. And from the outside, it looks like nothing has changed. But internally, something has changed, because each time those resistance levels are tested, the cost of holding them increases. Not in a visible way, but in the form of capital required to maintain positions and manage exposure. And as the underlying physical conditions tighten, that cost continues to rise. Eventually, the system reaches a point where maintaining those levels is no longer efficient. And when that happens, the behavior shifts, resistance breaks, price moves higher, and a new level becomes the point of consolidation. Then the process repeats. Another level is tested, another defense is attempted, another break occurs. This is how repricing happens in constrained markets. Not as a single explosive move, but as a sequence of step changes, where each move reflects a new understanding of what the underlying conditions actually support. And each step higher makes the next defense more difficult, because the system behind the price is becoming tighter. Now focus on timing, because timing is what turns a slow buildup into a rapid adjustment. The upcoming delivery window is not just another cycle. It is a moment where decisions have to be made. Participants holding contracts must choose whether to roll forward or stand for delivery. And those decisions are influenced by everything happening in the background. If physical tightness is increasing and supply uncertainty is rising, the incentive to secure metal now becomes stronger. That is how behavior shifts. Not because of a headline, but because the risk calculation changes. And when enough participants make that shift at the same time, the system has to respond. That response can take different forms. It can involve higher premiums for those willing to settle without delivery. It can involve adjustments in spreads between contracts. It can involve changes in inventory flows as metal is moved to meet obligations. But all of these responses have one thing in common. They increase the cost of maintaining the existing price structure. And when cost increases faster than the system can absorb it, the adjustment becomes unavoidable. That is when price begins to reflect physical constraints rather than just paper positioning. And that transition is rarely smooth because it involves a shift from one type of equilibrium to another. At the same time, external demand does not pause. Industrial users are not trading contracts. They are securing materials for production. If they see signs of tightening supply, they act. They increase procurement, they lock in inventory. And that behavior removes additional metal from the available pool, which feeds back into the system and increases pressure further, so the process becomes self-reinforcing. Tight supply leads to increased demand for immediate delivery. Increased demand reduces available inventory. Reduced inventory increases sensitivity to further demand. And all of this is happening while upstream supply faces new constraints. This is why the current price level should not be interpreted as equilibrium. It is a temporary balance point where opposing forces are holding each other in place. But the balance depends on conditions that are changing. And as those conditions change, the balance becomes harder to maintain. When the adjustment finally occurs, it often feels sudden, even though the underlying causes have been building for an extended period. That is because most observers focus on price and ignore structure. They see the move, but not the buildup. And by the time the move happens, the opportunity to understand it has already passed. This is the difference between reacting to price and understanding the system. Price is the result. Structure is the cause. And right now, the structure of the silver market is showing multiple points of stress that are aligning in time. Inventory is lower. Supply flexibility is reduced. Demand is stable to increasing. And a key delivery window is approaching at the same time a supply constraint becomes active. That alignment is what creates the potential for a rapid shift. Nothing in this process requires speculation. It is based on observable relationships between supply, demand, and market structure. The variables are known. The timing is known. What is not known is the exact moment when the system transitions from holding to adjusting. But what can be said with confidence is that the conditions required for that transition are forming. And once those conditions are in place, the system does not need a large trigger. It only needs a small imbalance to begin the process. That is where silver is now, not at the end of a move, but at the point where the underlying pressures are becoming difficult to contain. And when containment fails, the repricing that follows is not gradual. It is decisive because it reflects a shift from expectation to constraint. This is what recession warnings is built to identify. Not just where markets are, but how they function under stress. Because when you understand the structure, you can see the shift before it becomes obvious. And in this case, the structure is showing a market that is no longer as stable as the price suggests. That is the setup going into the next phase.